How do interest rates affect your real estate returns? Today, we're going to talk about what's the difference between positive leverage and negative leverage, and how can a deal still go bad even with positive leverage. After the 25 basis points rate increase this past July 26th, the Feds have now raised the interest rates in total of 11 times since 2022.
We've been talking about inflation being too high for more than a year.
Just a catastrophically high inflation rate.
You may or may not have felt the effects, but we've already seen what it can do to banks. For real estate, the most common term explaining debt in relation to cash flow is positive leverage and negative leverage. Hello investors, my name is ADRIAN and welcome back to the channel. In this video where I talk about the capital stack, I explain how debt can increase capital returns. But what we didn't touch on is what it does to cash flow. The two most common terms explaining debt and cash flow is positive and negative leverage. Let's start with positive leverage. That is, when the annual cash flow yield is greater than the interest rate charged by the lender. The annual cash flow yield is your NOI divided by the purchase price. This will be expressed as a percentage. As an example, if you have a loan with an interest-only payment of 5% and your annual cash flow yield is 8%, then you have a positive spread of 3% for every dollar you borrowed. This concept is not new. It's the most common way to make money. The same principle is used in rental arbitrage, and this is also how banks make money. They give you an interest rate for opening a savings account with them, then lend that money at higher interest rate so they profit from the spread. So how does positive leverage affect the performance of your investment? Let's say you bought a property for $10 million at an 8 cap. You have an interest-only loan at 5% with a 60% loan to value. Since we know the price and the cap rate, using the cap rate formula, we can expect the property to produce $800,000 in net operating income. After we deduct the annual interest payment of $300,000 to the NOI, the cash-on-cash return is 12.5%. Remember that the cap rate assumes the property was bought with all cash. Notice that the property is producing an 8% return. But because we have a 3% spread for every dollar we borrowed, we're able to get a 12.5% return. Now let's move on to negative leverage. Using our previous example, what if the interest rate were at 8% and we bought at a 5 cap? Our interest payments will now be at $480,000 and our NOI is $500,000. Using the same calculation we did earlier, as you can see, negative leverage severely hurt our cash-on-cash return. It's way below the property's return. Notice also that we're hovering very close to being on the negative. If the NOI decreases by 6% the following year, the investors will now have to add more capital to keep the property. This is also what is called a capital call. Now, having a negative leverage is not always a bad thing. Development projects are always negative during the first couple of years because there is no stream of income. In the same way, having a positive leverage does not always mean the deal is doing very well. This is a scenario where you can still lose money with positive leverage. To illustrate this, let's use our previous example. Say we bought this property at a 6 cap with a 4% interest-only loan. And due to inflation, a major employer leaving the area, or bad operators, the property's NOI is declining by 2% every year. As you can see, year over year, we still have a healthy cash-on-cash return. Now in year 5, we decide to sell the property. Let's use the same cap rate we used when we bought the property, which is a 6 cap. And by using year 5's NOI, the property's value is at $9.2 million. After we pay the principal of the loan, we're left with $3.2 million from our initial equity of $4 million, or a 20% loss. So why is this relevant? Well, because we're in that kind of environment right now. See, the way the banks determine the interest rate for their fixed debt is by looking at a benchmark. In this case, it is the 10-year treasury yield. Then they add a spread to that benchmark that usually is around 200 basis points or 2%. By looking at this chart, cap rates and the 10-year treasury yield are within reach of each other. Mind you, cap rates are very localized, and it's also different depending on the asset type. That is why being informed is the best defense you can have against losing money. Now that you've seen and understood that a high cash-on-cash yield doesn't mean a successful deal, you can now watch this video where we dive deeper on how the cash-on-cash metric is used in commercial real estate.